Hi, everyone. I'm just created this mini lecture. The two study guides I'm going to show you, you would also be able to view. They might be slightly different in the additional resources. Something I forgot to mention before is that with the change in Leo, I have very little ability to change things in our class. So much of the capabilities I had before, I no longer have. So when we get farther into the course, there's some things I'll mention that I couldn't change, just so you know. But if I mention it now, you're going to forget. So for right now, what I just wanted to let you know, the reason that you're going to see these study guides slightly different now than you will in the additional resources section is because I had no ability to change it. All I could do is add it over for my previous course, but I could not change anything. The other thing I want to tell you, in case you missed the last recording, just so you know that additional resources is not anything having to do with our current course homework. It is just from previous years, quite a few years ago, just to give you more of a feel of an in-person class. If they do not help you understanding anything regarding the course content, then just don't view them. So the first thing I want to show you is our chapter 1 study guide. And there's just a few things. Again, I'm adding this. You're going to find this in the from the professor discussion. I'm adding this to to our discussion regarding this lecture. But most of it you can just read on your own. Some of the things I wanted to point out, though, are first of all the accounting equation, which is just assets equal liabilities plus owner's equity. These two sides must always be in balance. And there's some homework problems related to this. What you have to do maybe to solve some of the homework problems is just rearrange the equations. And then I'm explaining what assets are. They're just economic resources owned by a company to benefit future operations. Liabilities are going to be obligations of a business to pay cash or perform a service or transfer assets in the future. And owner's equity is the ownership claim on total assets. You can have increases in owner's equity by investments of the owners or by revenues, and decreases in equity by drawings from the owners or expenses. And here's just a little brief problem I included just to get you thinking about how to adjust the accounting equation. But just remember, the accounting equation is assets equal liabilities plus owner's equity. We have various asset accounts. These are not all the asset accounts. And just so you know, when you're actually, you have these accounts, you actually have numbers for all your accounts. They're generally arranged in order of liquidity. And you might have like spacing in the numbers just in case a company comes up with a different account in the future. They want to put it where it should belong, again, according to liquidity. And liquidity just means how quickly it can be changed into cash. So a cash account, I think we all know what cash is. Another asset account is accounts receivable. What an account receivable is, easy way to think about it, is you go to Macy's and you have a Macy's charge card and you charge a blouse you buy at Macy's and it's $50. The transactions occur, the companies earn the revenue, but no cash is passed hands. That is what account receivable is to Macy's. It's somebody they've earned the revenue, but they don't have that money yet. That's an account receivable. A note receivable it's just a written promise to pay. It's more legal in nature, but it's kind of the same idea as an account receivable, or it could be a definite sum of money that they're owed, but it's generally along the same lines. Prepaid accounts. There's can be several different prepaid accounts, but what a prepaid account is you paid for something ahead of time. So if I buy an insurance policy for 1 year and I pay for it January 1st, I'm paying for it for the whole year. I do not consider that an expense of the business. It is considered an asset, a prepaid insurance asset. It is not considered an expense until I actually owe that insurance money. Supplies, those are just basically assets you have. It's very small things, maybe paper and pens, things like that. And it's considered an asset until you use it. Once you use the supply, it becomes an expense. But until you use it, it's an asset. Equipment, that could be something, maybe the company bought a machine. It's something that's good, they're going to use for more than a year. It is gradually expensed out in something called depreciation, but we'll talk about that at a later date. I think we all know what buildings are, and we all know what land is. Land is something that is not depreciated. Liability accounts, and there's no easy way to remember asset accounts except just to try to look them up or just remember them. Liability accounts are claims by creditors against assets. What you have most of the time, not all the time, but most of the time, it's easier to spot a liability account because it will have the word payable or liability in it. Not all the time, but a lot of the time. Accounts payable is just a promise to pay at a later date. So let's say I'm a company, I go into a supply store and I buy paper, but I don't pay for it with cash. I charge it on my charge card for that store. I have a store account with them, and I charge it on that account. That's an account payable to me, the company. I've got the item, I've got the paper, but I did not pay for it yet. That's an account payable. Notes payable, kind of the same idea. It's more legal in nature. And a note payable, it could be something short-term or long-term, just so you know that. Unearned revenue. What this is somebody pays me before I perform a service. So let's say I'm an accountant and it's the month of February, and one of my clients pays me to prepare their tax return, and I don't prepare it until March. That's an unearned revenue to me in February because I haven't done the work yet. I've got the money, but I didn't do the work. And then there's various other accrued liabilities. And we're going to talk more about this as we go along. I just want to give you a general idea. We have equity account, owner's capital. What that is the actual owner's investment in the company. So, and we're talking about a sole proprietorship right now. So if I'm a sole proprietor and I put 100,000 cash in the business, for example, that's going to increase the owner's capital account and increase the cash. Owner's drawings is the owner taking something out of the business. They're withdrawing funds from the business. Revenues, that's where let's say I'm selling products or services, whatever I'm doing. So if I'm an accountant, my revenue, and I perform a tax return, my revenue is the money I get for completing that tax return. Expenses are the costs of generating revenue. So that, and there's various expense accounts. Easy way to identify expense accounts. A lot of the times, not all the times, but a lot of the times it has the word expense. Same with revenues. A lot of the time it could say just sales, but a lot of the time it'll include the word revenue. So those are easy ways to identify some of these accounts. The rest of this you can probably understand on your own by reading it. And now I want to talk a little bit about debits and credits. So let me share my screen again. This is the Chapter 2 study guide. Debit just means left. Credit just means right. That is literally all they mean. It's like you're learning a new word for the word left and a new word for the word right. And what we're talking about is entering this. It really, if you think of a T account, and a T account looks just like a T, you'll see them when I show you some homework examples. But it's basically the T account. If you look at a T account, the left side of a T account is a debit. The right side of a T account is a credit. They mean nothing more. They're not good or bad. They're not positive or negative. It just means left or right. There are certain types of accounts that increase with a debit and certain types of accounts that increase with a credit. I like to use the acronym DEAD, which means those types of accounts that are going to increase with a debit and they would decrease with a credit. So if an account increases with a debit, it decreases with a credit. The reason I use the acronym DEAD is that means account's normal balance, or how you increase it, is with a debit. That stands for expenses, assets, and owner's drawings, or if we were a corporation, dividends. So that's what it's telling you, that acronym. And the other item, which isn't included in the acronym, is losses. Losses also increase with a debit, decrease with a credit. If you can remember the types of accounts that increase with a debit and decrease with a credit, if you memorize those, you'll know all other types of accounts are going to increase with a credit and decrease with the debit. So I did list accounts that increase with the debit balance, assets, here they are, assets, owner's drawings, expenses, and losses, and the types of accounts that are going to increase with the credit. And again, if it increases with the debit, it decreases with the credit. If it increases with the credit, it decreases with the debit. So the types of accounts that increase with the credit are liabilities, owner's capital, which are investments by owners. If we were a corporation, that would be our stockholders account, but we don't have that. Revenues and gains. So that's basically all that means. Debit and credit, just think of it, a new word for left, a new word for right. And then you could probably read the rest of this yourself. We use a ledger. In place of a ledger, we use T accounts. But what occurs is when a transaction occurs, you look at that transaction and you determine if it has to be recorded. If so, the first place you're going to record it is in the general journal. And all the general journal is just basically just a bunch of transactions, one after the other after the other. What you're then going to do is you transfer the information from that general journal into a ledger, or what we're going to use as a T account. And all the general ledger think of it as a bunch of folders. So you'll have a cash folder, and you'll have an account receivable folder, and you'll have an account payable folder. It's just thinking of it as a bunch of different folders is probably the easiest way to think of it. After you do that, eventually what you do is you end up creating a trial balance. So that's the next thing you're doing, is creating a trial balance. And that's just listing of the account balances as a debit or a credit, just the total account balances. And that's basically all there is. There's more information about here of dollar signs and different things. We don't use dollar signs when we're doing general journal entries or posting to the ledger or the T accounts. We're just going to use them for like trial balances and our financial statements and things like that. So let me stop the share. I just had like this mini little problem I thought might kind of go through everything for you. So let me share my screen again. Here's my week one mini lecture. And just to give you an idea of what we're doing, I thought to take it through the 3 steps, I thought I could show you that. So these are some transactions for Bob Company for the month of January. So on January 1st, Bob invests $10,000 cash in a small welding business of which he's the sole proprietor. So he's the only owner, and this is what he's doing. The way we would record that is on January 1st, we would debit cash, credit owner's capital. We would also include some type of explanation below it. For example, we might say, owner invests cash in business. I didn't do that here because I'm trying to keep this really simple. So I just wanted you to see how the debits and credits would work. When you're doing your homework, you don't have to do this debit and credit. If you'll note, my cash account, my debit account is flush left. And then if you look at the account I'm crediting, I have it indented slightly. You don't have to do that in the homework. It will indent for you by your noting whether the money is going to be a debit or a credit. When you put that amount in, it automatically knows you're crediting a certain account or debiting a certain account. But to go back to this, and I'm trying to make these video or recordings as brief as possible because I know you lose attention. It's difficult to stay focused. So that's why this is going to be brief. But Bob invests $10,000 cash in a small welding business of which he's a sole proprietor. You just have to kind of think this through in your head. So you would think cash. Okay, what kind of an account is cash? Cash, okay, that's an asset account. Assets account increase with a debit. So I'm going to debit cash. And when you debit something, it's flush left. And I'm debiting it for $10,000. Then you would think, okay, he's creating owner's capital. Okay, what kind of account is owner's capital? Well, it's owner's capital, right? Is that one of the accounts that increase with the debit? No, that type of account increases with the credit. So I'm going to credit owner's capital for the $10,000. We're going to think that all the way through. Okay, what we're going to then do is go ahead and post these to a T account. And like you can see, the T account basically looks like a T, right? It has a left side, it has a right side. So I'm posting this to the T account. So I'm going to post 10,000 on the debit side, right, the left side of the cash T account. And I'm going to credit right side of the T account, owner's capital for 10,000. Okay, next, my next transaction says purchases equipment on account for 6,000. Okay, I'm going to think this through again. What kind of an account is equipment? Equipment's an asset account. Asset accounts increase with the debit. So I'm going to debit equipment, I'm putting it flush left, 6,000. Crediting, here it says we didn't purchase this with cash, we purchased it on account, which means it's going to be a liability to us. How do liability accounts increase? Liability accounts increase with the credit. We're going to call this accounts payable. We're crediting it for 6,000. Next thing that happens is 2,000 cash is paid to the landlord for the January rent. Okay, so I owe this now. It's an expense to me. So I'm going to debit expenses, right? Because expenses increase with a debit. That type of account increases with a debit. So I'm going to debit rent expense. I'm paying this with cash. My cash is decreasing, right? I'm paying it out. My cash account will decrease. Since cash is an asset account, it increases with a debit, it decreases with a credit. So I'm crediting cash for 2,000. And I'm sorry, I forgot to show you where I put these on the T account. So let me go back to equipment. When I purchased equipment on account for 6,000, I debited, put on the left side of the T account, equipment for 6,000. I credited, put on the right-hand side of the accounts payable T account, 6,000. For this last one, I'm debiting rent expense by putting that on the left side of the rent expense T account, 2,000. I'm crediting cash, right? My cash decreased. So I'm crediting or putting on the right side of the T account, 2,000. Last transaction we're going to analyze. Send a bill to a customer for 5,000 after completing work for this customer on account. Okay, I earned this, right? This is a revenue to me. I actually earned it. I just didn't get the money yet. So remember, that's an account receivable. When we've actually completed the work, but we don't have the money yet, that's an account receivable to us. Accounts receivable is an asset account, so it increases with a debit. So I'm debiting accounts receivable, 5,000. I'm crediting service revenue, increases with a credit. So I'm crediting service revenue for 5,000. Again, if I looked at this at the T account, my accounts receivable is being debited by adding it to the left side of the account receivable T account. And my service revenue is being credited by adding it to the right-hand side of a T account. When you look at the ending balance, let's look at cash, for example. Cash, I have a debit of 10,000. I have a credit of 2,000. That means my ending balance is 10,000 minus 2,000. It's 8,000. All the other accounts, they only had one. So the ending balance is whatever we had debited and credited in the account. Okay, don't feel like, oh my God, I'm not getting this. Do not feel bad if that's the case. With accounting, you have to do it over and over and over again for it to start to click. So what doesn't seem to be making much sense now, just follow the pattern. You'll always have an example to follow when you're doing the homework. Just kind of follow it along. If you might have to do it 4, 5, 6 times for it to start to click. But just follow along, keep doing it. It will start to click. I remember talking to the head of the taxation department, the manager of the taxation department at Rush, which is a major hospital in Chicago, in my area. And he said he was in his 7th week of accounting before this stuff started to click in. So don't feel like if it's not clicking, just do it over and over and over, and it starts to click. The other thing I want to mention is that if you're having difficulty understanding something, reread that part of the chapter. Sometimes you have to read it 4 or 5 times for it to start to really click. So don't ever feel badly about not quite getting it, you will get it. All our brains run differently. Sometimes we have to do something 10 times to get it. Sometimes we get it after once or twice. So don't feel badly if you're not getting it. Just keep doing it over and over again. Even if you do the same thing over and over again, just do it over and over again until it starts to click. Okay, the last thing, I just want to show you how we would transfer this to a trial balance. So here I have the name of the company, trial balance, and a date. And if you look, I have this all as either a debit or a credit. So I just transfer these ending balances down. That's all you do. So cash I transferred, that's 8,000. For my accounts receivable, I transferred down the 5,000. My equipment, I transferred down 6,000. My rent expenses here, I transferred down 2,000. For accounts payable, transferred that down here. Remember, all these accounts were debited, so they're showing in the debit side. The rest of the accounts, their normal balances, are credits, so they're going to show up as the credit side. So again, I just transferred down my accounts payable 6,000, transferred down my service revenue for 5,000, transferred down my owner's capital, which is here for 10,000. The thing you're going to notice here, if you were to total this, my debits and credits equal. In accounting, your debits and credits must always equal each other. After every recording of a transaction, they have to equal each other. The T accounts, debits and credits have to equal each other. And in your trial balance, your debits and credits are going to always have to equal each other. So again, if you're not getting this right away, and I created a really brief lecture, you can go through the study guides. That might be really helpful too. But just when I go through the homework, I'm going to also kind of explain everything as we're going along. But don't get frustrated or don't think, oh my God, I'm never going to get this. You will. It might just take you some time because all our brains are different, but you'll get it. And if you ever have questions or you need help in understanding something, just feel free to give me a call or send me an email message. And that should be it for, oh no, it's not it, because I wanted to show you one other thing I forgot to mention. I think I told you I don't really have the ability to change things like I used to. So it's going to make things a little more difficult. The other thing for me, not for you, but as we go along and we get there, I'm going to show you things that you might need to know in future weeks, not yet. Something I forgot to mention to you with my first video is that you can reach, here, let me change this to student view just so you can see how this is going to look. You can reach, let me go back in and out just in case. Let me stop my share and go back in case it took it away. Okay, so you don't have to go into the content section to reach the assignments or the discussions. If you go to activities and assessments and you click on that, you can get to the discussions right through there. So you can get to your discussions. Also, if you go to assignments, you can get to your assignments right here. Okay, you don't have to go through the content section. The only other thing I wanted to mention, when you go to the content section and you go into Wiley Plus, so for example, I go into week 1 and I go into my homework and I go to my homework button, and after you're registered and you see the homework, I'm going to stop my share and start it again just so I can show you. They're going to give you the instructions as you go along in the homework. So just follow those instructions. So you will get, let me go back in and show you. You're going to get, here's the Wiley Plus. You're going to get all these homework questions. So if I looked at it in the student view, I'm going to get 10 questions. So you're going to get these. The other thing I'm going to tell you is you're reviewing your assignments. Not all of them will have media, which means a video to look at, but they will all at least give you the textbook information. If you click on that, it shows you what part of the textbook you need to read to be able to solve a problem. If you go, for example, if we go to question 4, you will see that it gives you, when you go to the e-textbook and media, it not only gives you a textbook, but it also allows you to click on a video And if you were to play that video, it's a walkthrough on how to complete the problem. And that should be it for my little mini lecture. I'm trying to keep these short. I know after 10 minutes, you can't really listen anymore. It's too much. But in my next lecture is going to go through the homework problems, where I give lots of examples. Well, one example for each of the problems I'm covering. That will probably go longer than 10 minutes, but you could always stop it and come back to it later. But again, you have a great week, everyone. If you have questions, please reach out. Bye, everybody.